How's everybody doing today? Welcome back to another episode of the Banker Next Door. This is the continuing series, The Lords of Easy Money. This is part 14, and today we are going to be covering chapter 12. This is the last chapter in part 2 of the book, which covers chapters 7 through 12. And before we get started here, I'm going to bring in my little trusty PowerPoint slide as our little guide here as we walk through this. So first, I'm going to start off with a quick review of chapter 11 in case anybody missed that last episode. So what happened? So we had Tom Honig, our hero of the story. Basically, he comes back out of retirement, goes to become a chairman at the FDIC. So Mr. Honig goes to Washington. In Washington, he creates what's called the Honig Rule, which was basically a design to break up the big banks, to break it up into the more mundane side and the far riskier side of banking. But while Tom pushed for a lot of support for this, he ultimately came up empty. He did have bipartisan support. He had both Republicans and Democrats that both liked what he had to do. He had the financial I should say some people in the financial press liked what he was proposing. So Tom did have support, but ultimately DC is DC, and they call it the swamp for the reason. And it got stuck in the swamp and it went nowhere. So, and like it says here, the reality of Dodd-Frank set in. That basically there just wasn't the political will to do something. DC had made their choice. They were going in the direction of Dodd-Frank and Basel III Accord and new capital rules, and they were going to drown the big banks in a web of complexity, bureaucracy, regulation, laws, to basically try to keep them in check and keep them from doing riskier things. Now, what Tom did do, and once he realized that was kind of a losing battle, he did push for more capital. He pushed for what he called tangible capital, and he pushed banks to keep more capital. And ultimately, that was a fight that he did win. He did win that out. He was a pain in the bank's butt, but he did make that happen. But however, what we found out though was as Tom was pushing for reform, the Fed was moving in the opposite direction. And then we really went in depth on the search for yield and how it basically bled into every sector of the economy. And we looked at some very specific examples. We looked at corporate debt and stocks. We looked at the oil industry. We looked at commercial real estate. We looked at the debt of developing nations and how eventually turned, and how the very concept of yield was turned upside down with basically negative bonds that went through mainly through Europe, but also some other sections of the world too. And then ultimately we wrapped up with the fact that basically Tom had no illusions about the reality of the current situation. So that was our review there of chapter 12. Now we are going to get into chapter 12 today. So chapter 12 is called Totally Normal. And we cover the years from 2014 to 2019 in this chapter. And now we are going to pick up here with the quest for normalization. So let's begin here. So during most of Jay Powell's career as a Fed governor, the central bank had worked hard to try to make things normal again. I don't know about that. This effort had been underway in stops and starts since the early start of 2010. Back then, FOMC members believed that the Fed's extraordinary interventions would be temporary, like kind of like transitory inflation. They were going to be temporary interventions. They even coined a term for reversing the ZIRP and QE programs called normalization. At least as far back as January 2010, the Fed was debating how to normalize. Credible arguments were made that the process would be completed by 2015, meaning that the Fed would have sold off the assets it purchased through quantitative easing and would have drained virtually all the excess cash reserves out of the banking system. This never happened. Instead, the bank decided to simply rearrange the definition of normal. Love it. Powell, for all his critiques, never cast a dissenting vote. And Powell, unlike Tom, started to soften his criticism, and he ultimately came to embrace the policies he once criticized inside the FOMC's closed meetings. When this happened, Powell's star began to rise. No coincidence there. So now we're going to go into January of 2014 and enter Janet Yellen as chairman of the Federal Reserve. So Powell's growing clout within the Fed was made clear as early as January 28th, 2014, when the FOMC members gathered in Washington, D.C. for Ben Bernanke's final meeting as the chairman. Ben Bernanke was leaving the bank on good terms. His service had been like wartime service. Oh, yes, dramatic wartime service. And he was best known for the dramatic bailouts and rescue packages he oversaw in 2008. When Helicopters Ben's last meeting began, it opened with sustained applause. The clapping came to a close when Bernanke's vice chairman, William Dudley, said, "We thought we'd just do this for a couple of hours," drawing laughter from the committee. What followed next was something akin to a royal ceremony. With all its orchestrated pomp and circumstance, on cue, the Fed governor, Jeremy Stein, nominated Janet Yellen to become the chairwoman starting the day after Bernanke left at the end of the month. This was just a ritual. The U.S. Senate had already approved Yellen for the job at the start of the month, but the formal vote was part of the Fed's internal process. "I would like to nominate Janet Yellen," Stein said. "Is there a second?" asked the governor, Daniel Tarullo. It was Jay Powell who formalized Yellen's chairmanship role. "I second that nomination," Powell said. Yellen was approved. Yellen's tenure at top of the Fed was remarkable in many ways. She was the first woman to hold the role, and she commanded nearly universal respect from her colleagues. Her intelligence was unmistakable. I'm sorry. I'm going to laugh at that one. Yeah. Captain Transit. She is never going to live down transitory inflation. Never. When she dies, her name is going to be Janet Transitory Yellen. Just so everybody understands that. She had the tactical ability to quickly absorb the complex financial information relayed by the Fed economists at the beginning of each meeting, along with a deep knowledge of the Fed, the U.S. Department of the Treasury, and the White House. Man, she could sure use some of that right about now. But the constraints placed on Yellen's tenure were also remarkable. She would serve only 4 years at the helm of the Fed, thank God. And she would spend a great deal of that time trying to unwind the extraordinary interventions that she had advocated during the Bernanke era. During Yellen's first year on the job, the FOMC was debating a central question. Should the Fed even try to normalize? The unemployment rate was falling. The economy was growing, even if that growth was slow. So why not just keep printing money indefinitely? Why not even expand the quantitative easing regime and promise to keep interest rates at zero indefinitely? The Fed could create money out of thin air, which seemed harmless and free from cost. Hey, why not? Just keep the party rolling. There was one big and compelling reason that many economists cited when they argued that the Fed should not normalize at all. This reason was the mysterious and near total absence of price inflation. The Fed's conservative critics warned constantly about price inflation, and there was good reason for it. That's how things had always worked. Printing more money devalued money and caused prices to rise. But the defining characteristic of the ZIRP era was not inflation. It was the surprising and scary specter of deflation. Deflation is the state of constantly falling prices, and it's a suffocating death spiral for any economy. People don't buy things when they know the price will fall. Companies don't make things when they know that those things won't fetch a good price. The shadow of deflation was now hanging over everything. The Fed poured more money into the world's economic bathtub, but there was a deflationary hole at the bottom, which no one could quite understand, causing all that money to drain away without causing prices to rise. Nobody was more surprised by this than the Fed. For 3 years running, the Fed had consistently overshot its predictions of how high inflation would be. Experts grappled with this puzzle and pondered what might cause it. Even by 2020, nobody was really certain. The prestigious Brookings Institute held a day-long seminar on the topic that year, attended by Janet Yellen and other leading economists. And the final verdict of the day's discussion might as well have been, who knows? Globalization probably had something to do with it. There were more workers working for less money, making cheaper products and generating more cash savings. The Fed's own past successes probably also played a role because they kept expectations of future inflation low, which calmed the bankers in a way that in turn really didn't keep inflation down. One important thing about this, from the Fed's perspective, was that the absence of price inflation disguised the extravagant inflation occurring in assets. Yes, remember, you have price inflation and you have asset inflation. So the price inflation wasn't showing up, but the asset inflation sure was. As long as prices didn't rise, the Fed had license to keep intervening aggressively by printing more money, which stoked asset prices yet further. Remember, we got to go back to the previous chapters. We got to go all the way back to Galen Greenspan at the beginning of the 90s. Remember, we talked about how the Fed under Greenspan made the conscious decision that they were going to focus on asset inflation, and that they were basically, asset inflation was good. The politicians, they loved, hey, the stock market goes up, the wealth effect, people feel richer. That's good. Politicians, good. Asset price inflation, no, keep that down. It's like, basically, it was like they were happy to let the asset inflation run rampant as long as price inflation stayed in check. And that's exactly what was happening here, and what has been going on for basically the last 30 years. So now we're going to move on to Powell's worry. Jay Powell in 2014 was determined to highlight the cost of the Fed's actions. He, as much as anybody inside the FOMC, was pushing for the Fed to normalize. After almost 6 years of highly accommodative policy, the risks are out there and continue to build, Powell began. What worried him more was the prospect of a sharp correction amplified by the liquidity mismatch in the markets that would damage or halt the progress of what is still a weak economy. He was saying that a lot of traders and hedge funds had built up risky positions using a ton of debt. He would know. If markets fell because inflated asset prices started to reflect their real value, in other words, junk, then these hedge funds would start selling off whatever they could to pay their debts. But in such a scenario, not many people would be buying much of anything. This is what economists might call a liquidity mismatch. The Fed was laying the groundwork for a market crash, and the possibility only grew more likely with each passing month of ZIRP and QE. If this wasn't enough for the Fed to pull back, there was another important reason. By keeping interest rates at zero and keeping the banking system so flush with cash, the Fed was leaving itself with little room to maneuver if the economy did start to sink into recession. His speech was remarkable for its clarity, but it was remarkable for another reason. It appeared to be the last speech of its kind that Powell delivered during an FOMC meeting. Not too long after that, his attitude appeared to change. So that was the very last time in 2014. That was the last time that Powell brought any of this up. Because Powell was told, if you want to go anywhere, you better shut your mouth. Okay, now, stamping down criticism of the Fed and Powell's shift. By February 2015, when he gave the speech, there was growing opposition to the Fed in conservative and far-right circles. The movement was led by libertarian figures like Ron Paul, a former congressman and presidential candidate. Paul was pushing a movement to audit the Fed, giving the public a chance to better scrutinize and govern the central bank. Paul's followers were animated by the long-held fears of hyperinflation and currency devaluation. Powell said that the increasingly vocal criticisms of the Fed were misguided. In fact, the Fed's actions were effective, necessary, appropriate, and very much in keeping with the traditional role of the Fed and other central banks, he said. The Fed's conduct, in other words, was entirely normal. He went out of his way during that speech to defend the very policies that he had been warning about internally since he had become a Fed governor. He said that unconventional policies such as quantitative easing were largely responsible for America's economic growth and that the critics of those programs had been proven wrong. After I joined the Federal Reserve Board in May of 2012, I too expressed doubts about the efficacy and risks of further asset purchases, Powell said. But let's let the data speak. The evidence so far is clear that the benefits of these policies have been substantial and that the risks have not materialized. Powell did not mention that he had warned in June that the risks of quantitative easing were not only materializing, but growing, and could lead to corporate defaults and a financial market crash. His reversal was noted by his colleagues at the FOMC who had previously argued alongside him. There was a shift, and I think it's noteworthy, said Richard Fisher, the Dallas Fed president. Fisher had been raising concerns about QE for years, and he believed that Powell played an important role in giving those concerns more weight. It mattered that Powell's office was just down the hall from Yellen's. He was important because he was a governor, Fisher said. Fisher was not aware of any study or new data set released between June and February that would justify a reversal of Powell's judgment about QE or ZIRP. There was no condition in 2015 that would have indicated or necessitated easing off that argument, Fisher said. More likely, he believed, was the effect of being a Fed governor. The evolution may well have come from being there longer, being surrounded by brilliant staff that has a very academic side to them and bias, Fisher said. You're living in a cloistered atmosphere. It's a different environment that when you're in, it's a different environment when you're in that hallway. You conform more. I don't think there's anything nefarious about it. I just think it's the social dynamic. In closed-door meetings, Powell continued to cast doubts on the efficacy of quantitative easing. I think we've never looked at asset purchases as other than a second-best tool, he said during the FOMC meeting in September of 2015. As Powell's rhetoric appeared to cool, the Fed was starting to take concrete actions that addressed the risks he warned about earlier. Janet Yellen moved forward on the plan to hike interest rates and stop quantitative easing. She was pushing to normalize in a real way. So here you have this shift from Powell. And if anybody has not read Ron Paul's very famous book, End the Fed, I highly recommend it. Highly recommend you read it. You have to read and understand both sides of the equation. You can't take one side of the story. You got to look at both sides of the story. And Ron Paul makes a highly compelling argument and a highly compelling case for auditing the Fed and making a lot of changes at the Fed. So I'll leave it at that for the moment. So now we're going to go into December 15th. The Fed raises rates for the first time in 9 years. In December 2015, the Fed raised rates for the first time in 9 years, boosting them by a tiny fraction from 0 to a range between 0.25 and 0.5, or basically a half, 0.25 and a half a percent. The era of living at the zero bound finally appeared to be over, but it wasn't ending quickly. The FOMC members believed they would raise rates all the way to 1.375% by the end of 2016, but they only raised them to 0.5%. Now, a little sidebar here. The FOMC hadn't raised rates since June of 2006 and hadn't raised rates above the zero bound for the previous 7 years since late 2008. That is just, absolutely extraordinary how long they left rates at zero. Just one of the most catastrophic things that they did. The Fed had somewhat better luck in ending quantitative easing. The bank had stopped buying bonds at the end of 2014, but it wasn't able to reverse the program as some had hoped to do. There was still about $2.4 trillion of excess bank reserves sitting in the vaults of the primary dealers on Wall Street, and the Fed still owned $4.5 trillion in bonds that it had purchased through quantitative easing. The ocean of cash on Wall Street was akin to a permanent low interest rate. If the Fed ever wanted to truly tighten the money supply and reduce the pressure to search for yield, then it would need to start drawing this money down. The Fed was normalizing slowly, in part because of the sheer size of the task. Excess bank reserves were about 135,000% higher than they had been in 2008. The Fed's balance sheet was about $4.5 trillion, almost 5 times its level in 2007. Interest rates had been pinned at zero for nearly 7 years. Caution was the Fed's guiding principle as it sought to reverse these changes. Now, remember back to what Tom Honig said, what he had warned. He said, if you go down this path, it is going to be insanely difficult to reverse. And you're going to end up doing way more than what you think you're going to do. And everything that Tom said proved absolutely 100% true. And this is, and to go back to an earlier point about inflation, This is why here you didn't have the inflation, because there were still 2.4 trillion in excess bank reserves sitting in the vaults of primary dealers on Wall Street. In other words, that money was sitting in the vaults of the big banks on Wall Street. $2.4 trillion was sitting in the vaults. It was not on the street. It was not in the consumer's pocket. It did not make its way into the larger economy. And the Fed paid them. They paid them to keep those reserves in place. That's a very key thing. They paid them to keep those reserves there. And the Fed still owed 4.5 trillion in bonds that it had purchased through quantitative easing. So right there between those two things, that is $7.7 trillion that did not go into the consumer's pocket. So what happened in 2020 when we had the insane amount of government stimulus? That money went right into the consumer's pocket. It was like it was injected like fuel injection into the veins of the consumer, trillions of dollars, boom, boom, boom. And that's why the inflation shot out. That's why we did not have the inflation here, but we had the inflation in 2020. So anyway, I digress. Let's keep rolling here. So the American body politic was not moving cautiously in 2016 when Donald Trump was elected president. This was the abrupt, unexpected event that would end Yellen's tenure at the Fed. So Janet Yellen's term as Fed chairman would expire in early 2018. As the end of Yellen's tenure approached, Trump interviewed a handful of candidates to consider as Fed chairman, including Yellen herself. After meeting with Yellen, Trump said he was impressed. Okay, so now 2017 here, we're going to enter President Trump. So Jay Powell was hardly considered a front runner for the job. When financial traders and bank analysts made bets about the next Fed chairman, Powell was seen as a far outside chance. But Trump's Treasury Secretary, Steve Mnuchin, changed those odds. Mnuchin recommended Powell directly to Trump. Powell also impressed Trump during the interviews. There was a view inside the administration that Powell and Yellen would essentially promote the same agenda when it came to monetary policy. What tipped the balance toward Powell was his approach to bank regulation. He was seen as more closely aligned with the Trump administration, which was working to scale back some of the regulation imposed during the Obama years. Trump went with Powell as his nominee. The Senate confirmed Powell quickly. Powell's selection was seen as a safe choice and a vote for continuity. He was not a dissenter. He would continue the path laid out by both Ben Bernanke and Janet Yellen. The path, in this case, would be the path to continued normalization. The Fed had gotten off to a slow and halting start in 2015 and 2016, but during 2017, the bank started moving forward in a real way. Powell was also seen in some quarters as an ally of Donald Trump on one key issue, helping peel away the regulations that were put on big banks. The Dodd-Frank law ensured that banking oversight was still divvied up among multiple agencies, including the FDIC and the Fed. This gave the central bank enormous influence over the rules governing Wall Street. Powell's vice chairman of bank supervision was Randall Quarles, a former Carlyle Group employee who had also worked for Jay Powell at the Treasury during the George H.W. Bush administration. Quarles met with bank lobbyists in the Fed's boardroom in the Eschels building to hear out their concerns. The Fed softened rules around the stress tests and eased back parts of the Volcker rule that would have given bank examiners more power to assess how banks valued their assets. Okay. So now we're going to move on to Yellen's end and Powell's selection. So now at the time, Tom Hoenig was moving in the opposite direction. I'm sorry. I guess we already did Yellen's end and Powell's selection. Now we're going into Hoenig's time at the FDIC ends. At that time, Tom Hoenig was moving in the opposite direction. It was unclear at first what Trump's victory might mean in terms of banking policy and for Tom's career trajectory. Trump had cast himself as a hero of the working class and criticized big banks. Less than a week after Trump's election, the Wall Street Journal ran a brief story reporting that there was speculation Tom might even be elevated to chairman of the FDIC. There was also discussion that Tom could join the Federal Reserve Board of Governors as vice chairman overseeing bank supervision, the job that Randall Quarles would eventually get. By late 2017, the Trump administration needed to make a decision about Tom. His term as FDIC vice chairman was coming to an end. Tom said that he was willing to remain in Washington, but only as the FDIC's chairman or the Fed's regulatory chief. I did make it clear behind the scenes that for either of those two positions, I would be willing to stay on for a while, but not just to sit there. He wasn't optimistic about his future in Washington. He'd been antagonizing the big banks since he arrived, and he knew that these many fights had dimmed his chances at promotion. He had even been warned about it. It was suggested to me rather indirectly that I should tone it down if I expected to really have an opportunity to do these other things I might want to do, Tom later recalled. I just ignored it because I don't have an interest in changing my views. If that's what it takes, I don't need this stuff. So in January of 2018, Tom got his answer from the Trump administration. It came in a phone call from a staffer whose name Tom didn't recall later. The staffer thanked him for his hard work. Tom was also informed that even if he wanted to stay at the FDIC, he no longer had the option. The White House had nominated a senior banking attorney named Jelena McWilliams to fill Tom's seat. McWilliams was going to be the FDIC's chairwoman. In April 2018, Honig left the FDIC and returned to Kansas City. There was no doubt about what his departure would mean for the fortunes of the big banks. Bloomberg News reported the story under the headline, "Wall Street's least favorite regulator is calling it quits." So, kind of an unceremonious end to Tom's career there, and I think it's highly unfortunate that it ended that way. I think that, as we'll see here as we get through the rest of the book, I mean, pretty much everything that Tom espoused came true and panned out in one way or another. And, he was right about everything. He really was. He was really right about everything. And it's a shame. I hope somebody writes a really good memoir about him one day that kind of heralds him in the light that he should be heralded, but we'll save that conversation for the end when we get to the end of the book. So now we're getting into February of 2018. Basically, Powell becomes the Fed chairman. So the Fed had raised interest rates 3 times in 2017, bringing its targeted rate to 1.5%. Maybe even more important, the Fed finally began to reverse quantitative easing in October, selling off the bonds it had purchased earlier. The Fed promised to keep normalizing steadily during 2018 and beyond, drawing down the size of its balance sheet from $4.5 trillion to somewhere between $3 trillion and $1.5 trillion. So I think it's very important to note a couple of key things here. The Fed had tried to slow down quantitative easing a couple of times, and every time they tried to stop it, the stock market began to regress. The stock market began to pull back. And basically, they had turned Wall Street into basically like this junkie that they had to have their quantitative easing at all costs. And every time they took it away, that junkie came back looking for another fix. And so they had to turn that printing press right back on and keep pumping it out. Now, there was an interesting thing that happened, though. Donald Trump came in, and in 2017, they got through tax cuts, and the economy really started rolling. He got the growth going again. So that gave the Fed cover to actually start to pull off the gas here on quantitative easing. And that's a point that needs to be made. So the Fed promised to keep normalizing steadily during 2018 and beyond, drawing down the size of its balance sheet from $4.5 trillion to somewhere between $3 trillion and $1.5 trillion. The difficulty of this effort was apparent as soon as Jay Powell took the job. The Fed had barely begun to normalize, but the financial system was already falling apart. On Monday, February 5th, 2018, Jay Powell was welcomed to his first day on the job as the Fed chairman. The stock market plunged. The Dow Jones Industrial Average fell by 1,175 points, its largest single-day drop in history. Just a few days earlier, the average had fallen by 666 points, the largest single-day drop since 2008. The market turbulence was not a sideshow. It was tied directly to the Fed. As the central bank normalized its operations, it was doing nothing less than rearranging the global economic order because it was now at the center of it. The reality was described in a 2016 book called The Only Game in Town by the influential investor Mohammed A. El-Arian, the CEO of the investment powerhouse PIMCO. When El-Arian talked about the only game in town. He was talking about the world's central banks. They had become the anchor of economic development as democratic institutions were increasingly mired in dysfunction around the world. The problem with this arrangement was that central banks weren't built for this job. All they could do was create more money. Somehow, the world was now depending on the one set of institutions, central banks, with one of the narrowest set of instruments at their disposal given the task at hand, L. Arian wrote, and the longer such policy was in play, the greater the probability the costs and risks would start outweighing the benefits. Okay, now we're going to go into when the Fed acted, it affected everything. When the Fed acted, its actions affected everything. The market turmoil of 2008, 2018 had many faces and emerged from many places, but there was a singular important force that was driving it. What appeared to be a series of unrelated market panics was actually the result of smart investors reacting rationally to what the Fed was doing. These investors listened to Jay Powell and took him seriously. The age of ZIRP was coming to an end. Even if it was ending gradually, the big money had to move in different directions to accommodate this new reality. Powell's leadership on this front was steady from the very beginning when he took charge. The FOMC hiked interest rates on a predictable schedule and at regular intervals. The bank sold off billions of dollars in bonds each month, sucking the excess cash back out of Wall Street and easing the very high pressure it had created to search for yield. The reason to do this, Powell said, was the economy's underlying strength. In June, the Fed hiked rates again to a range between 1.75% and 2%. This was the highest that short-term rates had been in a decade, but it was still an early landmark on a long road ahead. If the Fed wanted to have significant power to cut rates in the future, when it came time to ward off a crisis, then the bank needed to push rates to 3 or 4%. During Powell's first 8 months on the job, he met with 56 lawmakers on Capitol Hill, splitting his time almost evenly between Republicans and Democrats. Janet Yellen, by contrast, had visited just 13 lawmakers during the same period in her tenure. Powell formed connections that would provide him support if the Fed was ever drawn into political disputes. So now we're going to go into the Fed continues normalizing. So as Powell built support, he continued the efforts to normalize, with the FOMC continuing to hike rates at regular intervals. The Fed was continuing to reverse QE by selling off roughly $50 billion in bonds every month. During a news conference in late September of 2018, Powell signaled that the Fed would keep tightening. These rates remain low, he said. This gradual return to normal is helping to sustain the strong economy for the longer run benefit of all Americans. In October, Powell once again pressed hard on this point. During a public economics forum, he said the interest rates were a long way from being at the neutral level, meaning that they were still well below the level at which they neither helped nor hurt the economic growth. The implication was that there were many more interest rate hikes to come. The markets fell sharply after this, with the Dow dropping 5% in just 2 days. Among the worst hit stocks were banks and energy companies. Powell might have quietly forged political alliances in Washington, but there was one relationship that he could not manage: his relationship with Donald Trump. The public dispute between Trump and Powell helped overshadow the slow, chaotic unraveling of the global financial system. By the end of 2018, the reality of normalization was beginning to express itself. And so now we're going to get into obfuscation in the market narrative. So the direct relationship between the Fed's actions and the market volatility was obscured in part because there was always a short-term explanation, a new headline of the day to explain what was happening, a la your lovely CNBC, Fox Business, and Bloomberg. They love their short-term explanations. When the value of technology stocks began to fall, for example, the headlines described the increasing political scrutiny on monopolistic tech companies like Facebook and Google. The headlines were accurate. There really was an increasingly powerful movement to regulate technology companies. But a larger force behind the stock market decline was the Fed's normalization. When the Fed diminished its pressure on investors to put their money into stocks, the investors first withdrew their money from the stocks that were most overvalued. These included technology stocks, which had drawn so much attention from investors during the years of ZIRP. But once again, the larger force was the Fed's normalization, which coincided with similar actions from other central banks. In December 2018, the European Central Bank followed the Fed's lead and ended its own version of quantitative easing. The tightening financial conditions exposed the rot that had formed in global debt markets. China was a particularly instructive example. It was suffering from a debt crisis and a wave of asset bubbles that its government and central bank helped create over the years. I think they're pretty much still suffering from that right this minute. Private sector debt in China had nearly doubled since 2008 and amounted to more than twice the level of China's annual economic production. This enormous level of debt could trigger adverse dynamics as borrowers found themselves unable to repay in the event of an economic slowdown. The trade war overshadowed a deeper problem in China that had to do with cheap money and high asset prices. Okay. So now we're going to move down here to our final slide, and we're going to get into the last three parts here. So December was the pivotal month. There was a broad global downturn that was scary in the way that it seemed to affect everything. Usually, markets for different assets and different commodities move in different directions. When stock prices fall, for example, gold prices rise as investors rush for a safe haven. This didn't happen in December. Instead, the downturn was broadly synchronized across asset classes in a way that shocked Wall Street traders. Stocks ended the year down about 6%. Even high-quality corporate bonds ended down 6%. Crude oil prices and other commodities were down about 15%. It was the beginning of a global retreat from risk and a reshaping of the economic system after ZIRP. If the instability continued along this course, it could threaten the global banking system, intensifying the global economic slowdown, or even lead to another financial crisis that could cause the unemployment rate to jump quickly. Jay Powell made a choice in mid-December to stand firm in the face of these risks. He was saying that the Fed would not be deterred by the market turmoil. Financial traders took Powell at his word and responded rationally. They started dumping their riskier assets. On Christmas Eve, a normally quiet trading day, the Dow Jones average fell by 653 points, nearly 3%. This smelled like panic to the Wall Street types. The Dow was now down about 19% since October, just 1 percentage point short of an official bear market, meaning a downturn that generally presages a recession. A terrible economic reversal was in the making. When the full shape and scope of this economic tyrant came into view, it would be only a matter of weeks before Jay Powell surrendered entirely. So they were gradually increasing interest rates, and this is 2017 and 2018, and they were basically started to reduce their balance sheet. Their balance sheet had hit a high of 4.5 trillion, and now they wanted to think about this. They wanted to bring it down to like 1.5 trillion. So they wanted to sell off and reduce it by $3 trillion, by over half. They didn't get anywhere near that. And as they started to sell off and as they started to just increase interest rates a little bit, the markets began to completely collapse. So now on January 25th, 2019, a story was leaked to the Wall Street Journal. It turned out that the Fed's reversal of quantitative easing might not be as automatic as Jay Powell said earlier. After the FOMC meeting that month, Powell emerged to give a news conference. He began his comments with a litany of technical points and data, but he didn't obscure the central message. Normalization was effectively over. The bond sales were over. The interest rate hikes were over. The tightening was finished. The case for raising rates was weakened somewhat, Powell said. Powell's language was colorless, but the traders on Wall Street heard his message clearly. Powell's reversal had been total. The moment coined a term in the investing world, the Powell pivot. This phrase was just another way to describe the safety net that Wall Street assumed the Fed would provide. They called it a put, in a contract to buy a stock at a floor price if it ever sank too low. There was the Greenspan put, then the Bernanke put, then the Yellen put. Now we had the Powell put. It had become a de facto policy, the Fed put, that implied the Fed would create a floor to asset prices. By February 3rd, days after this announcement, the value of stocks and bonds were rising in tandem, a rare thing to see. It soon became clear, however, that simply stopping normalization would not be enough. The world economy was like a big building with bad wiring that was smoldering behind the walls. Some rooms were smoky, some rooms were just hazy, and it seemed that open flames might break out at any moment. Deflation was a central problem. Powell acknowledged that the puzzling lack of inflation was a large reason. I don't feel we have convincingly achieved our 2% mandate in a symmetrical way, he said. It's one of the major challenges of our time to have downward pressure on inflation. So now we get to the finish here of the markets flashing red and Powell cuts rates. By March, shares of stock in banks were falling over worries about the financial system. The specter of a global recession was becoming more pronounced. The market sent out a particularly stark warning that month when interest rates on short-term bonds became higher than those on long-term bonds. This is something called an inverted yield curve. We might have an inverted yield curve right now today that might be the longest and deepest in history. Keep that in mind. Don't forget about that. That signals a coming economic downturn. Oh, really? In July, the European Central Bank announced it would cut interest rates largely because inflation remained alarmingly low. President Trump tweeted his fury about this development. He believed that the Fed should be leading the way on rate cuts and stimulus, not the ECB. In July, Powell led the Federal Reserve to something extraordinary. The bank would cut interest rates even though the economy was growing. The unemployment rate was 3.7%, the lowest it had been in about 50 years, and wages had been rising. This was the point in an economic cycle when the Fed normally kept rates higher, giving itself the power to cut them if the U.S. economy began to slow. The rate cuts were described as an insurance policy. The traders on Wall Street suspected that this insurance policy was just the beginning. Futures markets priced in 3 more rate cuts by the end of the year. Central banks around the world, from Europe to China to Russia, started easing again. They were the only game in town, and by August, the bankers were fighting off a global downturn. If Powell felt like he had control over the situation, that feeling was extinguished on the Tuesday morning of September 17, 2019. The members of the FOMC gathered that day in Washington for their regularly scheduled meeting, but the meeting was overshadowed by urgent reports from the trading desks at the New York Fed. An obscure but vitally important market for overnight loans had seized up. The problem was getting worse. If left unattended, it could lead to a financial crisis, maybe worse than the one in 2008. Very few people outside Wall Street even knew what was going on. The economy was as strong as it would be for years to come, but the financial system was so fragile it was about to implode. So that brings us to the end of chapter 12, and that is the end of part 2 of the book. And the next chapter we are going to get into is what are we going to? We're going to chapter number 13. And we're entering into part 3 of the book, which is the last 4 chapters, 13, 14, 15, and 16. But so what I'm going to do here in the next episode is basically I'm going to do a quick short review of part 2 of the book, which was chapter 7 through 12, to again try to just go over what we went through in those 6 chapters, just try to bring people up to date if you haven't watched all the episodes, and maybe you might have missed a chapter or two. But again, we've kind of laid out the groundwork of how we got here. Now we are going to see the true ramifications of what the Fed has done to this economy. Do not miss these last 3 chapters, because this is where all the fireworks are. This is where all the chickens come home to roost, and this is where everything, the whole nightmare of the ZERP and quantitative easing is fully laid out in front of everyone. And we're going to see how badly the Fed has perverted the markets, what they have done, what they have allowed hedge funds and basically big banks to get away with, and what we're still dealing with right now today. We're still dealing with it right now today, and we are going to deal with it for many, many years to come. So If you're liking this series, please make sure to like, share, and subscribe. That will absolutely help this series. It will absolutely help this podcast. Please make sure to check out some of my other, if you're enjoying this content, please check out some of the other content on the channel. Always make sure to check out the banking update, which is the main show of the channel, which I do every weekend, every Sunday. I try to get that out by every Sunday. And like I said, so if you like what you're seeing, please make sure to like, share, and subscribe. Please leave your comments down below. I love the comments that I'm getting, the feedback I'm getting on this series. Please keep that coming. And I will be back real soon to see you guys with the installments, hopefully coming up again next week. Thanks. See you later.